Welcome back. My name is Gosselin from Australian Fund Monitors. Alternative investments have long been considered an essential diversifier in a balanced portfolio, not only to provide good returns, but also to reduce downside risk in times of equity market turbulence. However, the strong performance of equity markets over the past 2 or 3 years, and particularly the tech sector and the Magnificent Seven, may have led to many investors ignoring the risks in bull markets and as a result being underexposed to alternative strategies. Today I'm talking to two fund managers, each with very different alternative strategies. Simone Haslinger from East Coast Capital Management, who runs a long-term trend-following futures strategy across multiple asset classes and markets. And Clint Maddock from Digital Asset Funds Management, whose digital income fund is involved in high-frequency, short-term trading in Bitcoin and other leading cryptocurrencies. Thank you both for joining Fund Monitors today. Simone, can we start by asking you about East Coast Capital Management?
Sure. So first of all, thanks for having me on the recording and great to be here alongside Clint. We operate the flagship ECCM Systematic Trend Fund. It's a quantitative strategy implementing our proprietary systematic program, which is based on the factor of momentum or trend following. So our algorithms are applied against a large and diverse pool of principally futures markets. We currently trade almost 90 internationally diversified futures markets, and it's across the spectrum of asset classes. So commodities, currencies, equity indices, bonds, and other interest rate products. We have a 5.5-year track record with a CAGR of over 11%, and we show a low correlation with traditional investments such as equities and 60-40 portfolios.
Thanks, Simone. Obviously, diversification is a really important benefit to your fund. Clint, turning to you, can you please give a brief overview of your digital income strategy, because it's significantly different?
Digital Asset Funds Management, and we offer a market neutral, very actively traded strategy in the digital asset markets. That's primarily in Bitcoin and Ethereum futures, and we've been going for just over 4 years now and returned over 130%, annualized at around 24% per annum. And of course, being digital assets, we're quite independent of the movements in your traditional finance markets, and our returns have exhibited a correlation to the S&P 500, for example, of negative 0.1, and even to Bitcoin, where we're showing a correlation of negative 0.3. So the proof's in the pudding there that it's a very uncorrelated, in fact, if anything, opposite correlation to the direction of the markets.
Thanks, Clint. Can you explain your fund's low volatility in such a volatile asset as Bitcoin and other cryptocurrencies?
Because we approach the market in a neutral fashion, that is, if we buy a Bitcoin, then we'll sell a future. And we're very, very active in trading. We'll do thousands of trades a day looking for small alphas that we can repeat over and over again. And the system trades that with the oversight of a human. And the market neutral aspect means that what we're taking advantage of really are the fragmented market, the discrepancies between the exchanges, between very, very similar products on the same exchanges. And because we're able to execute thousands of trades a day and capture small pieces of alpha, that we're immune to the markets going up or down.
Coming back to you, Simone, can you expand on trend following as a low correlation strategy?
Yes, so we have, obviously we're a quant fund, so we've got lots of data over a long-term backtest, but also over our 5.5-year track record. We are demonstrating low correlation to traditional asset classes, and we're expected to have low to negative correlation to equity portfolios and a 60-40 style portfolio over time. We actually do some analysis that we publish quarterly that looks at an efficient frontier. If you were to combine a traditional portfolio with our style, or a ASX 200 total return investment, or a Australian 60/40 investment with our product over our track record, we actually see that we push out the efficient frontiers. So for the same level of risk, you will have a higher level of return, or alternatively, for the same level of return, you'll have a lower amount of risk, investing a very material allocation to our style alongside a traditional portfolio. So very much a complement to a traditional portfolio, and low correlation. Absolutely.
So historically, does low correlation actually occur when markets dislocate?
So actually what we find, and we have the benefit of participating in a segment of the funds management industry that's been operating for over 50 years, and there's actually academic research on our style of trading that looks at data over hundreds of years. What we find is that the style tends to perform very well in periods of market dislocation, so it is quite robust across different market regimes. The risk is periods where markets don't trend very well, and we're actually in one of those periods now where there's a high level of market uncertainty and a lack of clarity as to direction. And so what we find is right now, a lot of trend following systems globally are in drawdown, but that also creates the opportunity, because when you have these periods of drawdown, it's a bit like value investing becoming highly attractive when you're in the middle of a big equity market correction. Trend following systems kind of shake out of the big trends that they've been in big periods of market uncertainty like we've just experienced. But as the trends take hold, you can expect with a system that has a positive expectancy, when the trends do emerge, you'll see great returns coming back out. So we really encourage people to have a look at our style, trend following style, at this time in the market and make a decision about the merits of those underlying funds on the long-term track records.
Simone, to what extent is the current uncertainty created by Donald Trump's tariffs affecting your process?
Yeah, absolutely. I think that's a big factor as to why we're seeing trend following systems in drawdown at the moment. So essentially, if you think about our style, it's a bit like a coin toss where we have lots of small losses that are limited on one side of the coin, and then we have on the other side of the coin gains that can be very large. And so as long as you keep tossing the coin over time, you have a positive expectancy. The key is being able to continue tossing the coin. And what we've just experienced now is the initial shock of trend reversal with some of the statements coming out of the Trump administration, and then the ongoing uncertainty as to how markets pull back out of this. But fundamentally, when we look at data over hundreds of years and we look at our segment of the industry that's operated for decades, we know that at some point in time, we will pull back out. At any point in time, there are trending markets. It's a question of having enough trending markets to offset those small losses, and then to ultimately pull us out of a drawdown. So yes, Trump is very much causing havoc in the industry.
If one of the benefits of your strategy is being able to trade across all asset classes and multiple markets, what is currently trending?
Yeah, so we are finding some bright spots in the commodity sector. I mean, we trade, as I mentioned, almost 90 international futures markets. So we're diversified globally, and we're diversified across asset classes, and commodities in particular are proving to be a bit of a bright spot. Obviously, equities have come right back, so we may find that equities continue to trend again. But certainly there are spots within commodities that are looking very interesting, and there's certain underlying more exotic trades. We trade all manner of commodities, and not just gold, which obviously has been a great trade for us over the last 12, 18 months. Contracts such as energies and oil, which perhaps could continue, remains to be seen where things land in terms of the Middle East at this point in time. But there are other sort of more exotic markets that we trade, and so we may well see a continuation. If we see inflation continue, we may well see a continuation in commodity price action, which could well be the pathway out.
Clint, looking at your strategy at DAFM, to what extent do trends or volatility in crypto markets assist or hinder you?
Trends in the crypto space, in Bitcoin in particular as the bellwether, typically times when our strategy performs well, but not amazing. So we have had some really outstanding months, which typically come at the end of the bull market in those first phases as it pulls back. So seen early last year, there was a pullback, and we had one of our best months in April of just under 10% after fees. We saw a big run up all through the year in anticipation of a Trump presidency and a pro-crypto stance, as well as a major adoption of ETFs in the States and somewhat here in Australia, as well as a tailwind to the broader digital asset base. So we had some really strong, consistent results with that strong trend up, but our best months were when the trend broke. We've done some research here. For every single month that the S&P 500 has been down, we produced a positive return, and on average, our outperformance per month was 4.9%.
So to what extent are digital assets, and Bitcoin in particular, becoming mainstream?
Yeah, I think when we're talking about allocations to the alternative space as part of a portfolio, you'll now find that digital assets, especially Bitcoin, are now part of that conversation. Whereas, say, 4 years ago, that definitely wasn't the case. Especially 3 years ago, in 2022, when there was all sorts of turmoil, particularly in the crypto space, and culminated in FTX collapsing and the Sam Bankman-Fried fraud. It's all doom and gloom, bear markets in crypto. So yeah, definitely not part of the conversation then. Bitcoin's now been around 15 years. If anything, it's as strong as ever. You know, it's the bellwether cryptocurrency, 15 years, no hacks, very solid. And the exchanges themselves have been hacked, but the blockchain that is Bitcoin has proven to be very, very resilient. So yeah, we've been going for 4 years, which has been a nice mark in the sand, and we're finding a lot more interest now as of being considered to be part of that alternative portion of asset allocation in the portfolio process.
While Donald Trump has disrupted many markets, to what extent has he assisted digital assets?
Yeah, when you look at the policies that Trump has favoured and looking to implement, they're very, very much pro crypto, pro adoption. Just in the last few weeks, we've had the Genius Act passed, and that's essentially a bill that will provide regulation around the creation and regulation of stablecoins in the US. And they already account for in the vicinity of $250 billion of assets in that space. And that's going to grow significantly with the passing of this bill and the follow-on from that. And so we're looking at also the types of companies that Trump and his family appear to be involved with, and they have a lot of fingers in a lot of pies in that digital asset world. So you can imagine the incentive that Trump has to create favorable conditions in that space. And wherever there's interest, wherever there's volatility in crypto, it tends to be a positive for our returns. So yeah, directly or indirectly, we've had a good run in the last 18 months on the back of one, ETFs, and secondly, the Trump presidency and his pro-crypto stance and policies.
Although both of you are quant managers, although very different, to what extent do you use AI?
So we use ChatGPT in our everyday lives, whereas our software engineers use something called Claude as one of the tools where we can get it to write us modules of code which we can plug in. So we're not having to share anything sensitive or any of our core IP, but we can get it to write chunks of code which we're able to plug into our systems. And we're finding that our staff are able to develop the software a lot more efficiently and effectively and safer than previously. So we're getting much more output from the same team than we would have got previously. So we're able to iterate our algorithms and our software faster than we would have in the past.
As far as you're concerned, it's a productivity tool.
First and foremost, the team's a lot more productive. But we are looking at AI tools to help provide us ideas for strategy and trading, but not with any great deal of success as yet. But we keep monitoring and testing to see what we can get out of it.
Simone, just asking you the same question. Do you use AI at ECCM, or is it more of a productivity tool?
Yeah, that's right. I'd say in short, it is likewise a productivity tool for us in the hands of our research team, and it's sort of helping us with analysis, coding at times as well. Ultimately our strategy's been around for a long time, and it really operates on, focusing on the signals and filtering out the noise. So, sometimes some of the buzz around a tool like AI can kind of create questions like, will it erode your edge as a quant fund? Fundamentally what we do is it's based on behavioral psychology, that we're taking advantage of the fear and greed that drives markets. And, as I mentioned, the academic research has gone back a really long period of time to demonstrate that this prevails. And over the decades that our sector's been operating, there's been huge technological advancements. It's certainly additive and helpful in the production of our product, but ultimately not really a disruptor as we see it today. But similar to Clint, we continue to try to embrace the new technology that's coming through and see how it can be useful to us. But ultimately, we need to stick to our long-term strategy, focus on the signals, filter out the noise.
Simone, can I ask you, what are the key issues you're facing at the moment?
So look, I think for us, it's really a lack of understanding of the trend following style in our market here in Australia. Our style tends to be better known in international markets, the US and Europe, and there aren't too many trend following programs being run out of Australia. So it's, we recognize that we're niche within alts. And so making sure that people understand what we do and get the messaging is really the key headwind for us at the moment. Fundamentally, I think most people invest in alts tend to be invested in private equity, venture capital, perhaps private credit. Maybe they're invested in digital asset. We also trade Bitcoin futures, so we have a little slither of exposure to digital assets as well. But really, we have a highly liquid strategy with transparent pricing. We have a highly diversified portfolio, but it's about getting out there and getting people aware of what we do and how we approach markets, and I guess the complementarity of what we bring to a traditional portfolio. So appreciate you inviting us to echo our message out there into the community, because that seems to be the key issue for us at the moment.
And following on from that, has the strong performance of equity markets over the past 2 or 3 years, particularly in tech stocks, made it difficult to get investors' attention?
Yeah, I think that's right. Although I do feel in conversations with investors more recently that there is a growing concern about equity valuations and geopolitical risks out there on the horizon. And so people are looking to engage with alternative strategies. I guess the trouble is that if you've already allocated to venture capital or private equity, you may be subject to gates and minimum investment periods as well. And it is easy to just say, well, if you're looking for a racy return, you might buy and hold a digital asset exposure, or you might buy and hold the NASDAQ or something like that. But it is really in the fullness of time, if you're thinking about diversifying your portfolio truly and having uncorrelated returns across your portfolio so you can sleep well at night. Equities have experienced in our lifetimes very dramatic pullbacks. And if you just have a buy and hold strategy, you're putting your portfolio at significant risk. So I agree. I think that is part of the challenge at the moment.
Clint, can I ask you what the key issues DAFM and digital funds are facing at present?
Well, the key issue for us, and it has been since the start, is the counterparty risk that we take on in order to run the strategy. And we highlighted that when we started the fund, and it's still an issue to this day. And we saw that actually come to fruition in 2022 when FTX collapsed, and we had 13% of our assets exposed. We've since got the majority of that back, thank goodness. But one negative month in 50 months of operation, and the thing that comes up in almost every investor meeting is, why did you lose money that one time? Like, can't we talk about the other 49 successes? No, it's the risk we face. So it is a key issue for us. And one of the solutions in the crypto space has been a move towards off-exchange settlement, which means that there's a trusted counterparty or custodian that sits in the middle between us as the exchange user and the exchange itself. So the custodian will hold our assets, and those assets will be mirrored onto the exchange in our account as equity, allowing us to trade. And then every 24 hours, we can settle the profit and loss of our trades with the custodian and the exchange. So if there's an exchange hack, then the extent of our exposure is the daily profit that we might have on that exchange. Our assets are no longer at risk on the exchange. It's no longer possible for a Sam Bankman-Fried to take client assets and move them away because he doesn't actually have control of them. So the majority of the exchanges we're trading are all moving towards this off-exchange settlement solution. Well, that's a key issue for us, to give us and our clients the peace of mind that our major risk of the strategy is being mitigated somewhat.
So it sounds as if trust over third-party risks are becoming less of an issue as the sector matures.
Yeah, that's exactly right. It's looking more and more traditional finance like the more we proceed through time, which is quite an interesting outcome for a Bitcoin which was created to circumvent the central governments and the trust issues we have in them, and the more success that it has, the more TradFi it becomes. That's definitely how things are progressing, but it also brings efficiency to the markets, which may or may not erode our alpha. But as we see it, look, we continue to iterate our strategies and make them more efficient as well. The more people that come into the markets, the more turnover and volume there is. The more counterparties we have to trade against, the more turnover that our algorithm is able to do. And we've seen that the last 18 months have actually been our strongest, most consistent period of trading since we launched the fund. So perhaps efficiencies in the digital asset markets are a net positive for our strategy.
So that's about it for today. If you want further details and analysis on either digital asset funds management or East Coast capital management, simply go to their full profile on www.fundmonitors.com. You can also invest and apply online to each fund via our olivia123.com portal. Clint and Simone, many thanks again for your time today. We look forward to speaking to you again in the not too distant future. In the meantime, best wishes.
Thanks, Chris.
See you, Chris. See you, Simone.